The stock market is down and there are fears of a recession coming. But it's not game over, because the strategies I'm going to show you can help you navigate these uncertain times and make even more money. While the S&P 500 saw a recent decline because of the weaker than expected job growth data, which prompted a sell-off in the stock market, long-term investors know that such periods of volatility are great opportunities to make more money. Here's the thing. After every major recession, the market has always bounced back, often delivering impressive gains. And those who stick to a solid investment plan usually reap huge rewards. This is where ETFs, or exchange-traded funds, come into the picture. But why do ETFs truly matter? See, ETFs have changed the investment game by making it simple and affordable to own a mix of stocks or bonds. Think of them as a one-stop shop for investors, where you can get to hold a little bit of everything, which reduces the risk compared to picking individual stocks. With over $6 trillion in assets under management in the US, ETFs have become a go-to for investors looking for true stability and growth. But the 3 ETF strategy I'm going to take you through in this guide is where things get truly exciting. As you'll find out, this method simply covers 3 main areas: foundational, dividend, and growth ETFs. It makes investing easier and more focused on your long-term goals, so you don't have to stress about the daily ups and downs of the market. I'll show you how to pick the best Charles Schwab ETFs to set yourself up for long-term success. You'll learn the basics of the 3 ETF strategy and how to make money following the 3 techniques, so follow closely until the end. Before I show you the 3 ETF strategy, we need to first break down what ETFs are. Let's say you walk into a bakery and there's a box filled with an assortment of donuts. Each donut is unique, but they're all packed together in a convenient box. An ETF is similar. It's like a box where you have a collection of different stocks bundled together into one investment. This allows you to invest in a variety of companies without having to buy each stock individually. But why are ETFs such a popular choice among investors? First, they're great for diversification. If you invest in an ETF, you're spreading your money across multiple stocks, which reduces your overall risk. Then there's cost effectiveness. ETFs often have lower fees compared to mutual funds, meaning more of your money is working for you. Finally, they have an overall ease of investment. With ETFs, you can buy and sell them just like stocks on the exchange, which makes it seamless to manage your portfolio. With all these advantages, it's no wonder ETFs are becoming the go-to investment choice for many. But what's the best way to utilize them for long-term growth? That's where our 3 ETF strategy comes in. Stay with me as we explore how you can build a strong, diversified portfolio with just 3 carefully chosen Charles Schwab ETFs. Now, the 3 ETF strategy is designed to simplify investing and maximize returns over the long haul. First up is the principle of simplicity. The idea is to select one ETF for each major category that we talked about: foundational, dividend, and growth. This approach makes managing your portfolio easy, without the need to juggle countless investments. Next, we have goal setting. Before diving in, take a moment to define your investment goals. Are you seeking steady income through dividends, or are you focused on long-term growth? Maybe it's a bit of both. You'll have a clearer roadmap to success by aligning your investments with your financial goals. The third big thing here is consistency. This is all about staying the course, even when the market gets rocky. Remember, investing is a marathon, not a sprint. You'll be well positioned to build substantial wealth over time if you simply maintain a steady investment plan and not get swayed by short-term market fluxes. Now that we've talked about the strategy, let's explore the best Charles Schwab ETFs to consider for your 3 ETF portfolio. First up is the Schwab US Large Cap ETF with ticker symbol SCHX. Why choose SCHX? Well, it is super stable and offers consistent growth. This ETF tracks the performance of the largest US companies, offering a solid foundation for your portfolio. You get exposure to household names like Apple, Microsoft, and Amazon, which are known for their resilience and ability to weather economic storms. Let's look at the performance analysis. Historically, SCHX has delivered strong returns with a relatively low risk profile. Over the past decade, it has averaged an annual return of around 10%, making it a reliable choice for long-term investors. But here's what's truly fascinating. Given the current economic trends and the continued dominance of large-cap companies, SCHX is poised for true steady growth. So you need to consider investing in SCHX if you're looking to set yourself up for stable investment that brings you some peace of mind. Next is the Schwab US Dividend Equity ETF with ticker symbol SCHD. This ETF focuses on companies with a strong track record of paying high dividends. The role of dividends in your portfolio is twofold. They provide regular income and contribute to overall growth as dividends are reinvested. But what makes SCHD stand out? It offers high yield and holds quality companies known for their reliable dividend payouts. This includes firms like Johnson & Johnson and PepsiCo, which have consistently rewarded shareholders. Let's say you invest $50,000 in SCHD. Over 10 years, assuming an average annual return of 12% and reinvesting dividends, your investment could grow to over $150,000, providing both income and capital appreciation. This shows just how SCHD can enhance your portfolio stability while generating passive income. Now let's take a closer look at the Schwab US Large Cap Growth ETF with ticker symbol SCHG. This ETF targets high growth sectors and companies, making it perfect for investors seeking growth opportunities. With SCHG, you'll be investing in innovative companies leading the charge in technology and other high growth industries. Here's the thing. Historically, SCHG has outperformed many other ETFs, with an average annual return of about 15% over the decade. This performance is driven by its exposure to tech giants like Tesla and Alphabet, which are poised for continued growth. But if you can include SCHG in your balanced portfolio alongside SCHX and SCHD, you're not only diversifying, but also capturing the potential for high returns. This balanced approach can help maximize your overall portfolio performance while mitigating risks associated with high-growth investments. Now that you've got your 3 ETF portfolio set up, it's time to manage it in a way that gives you the best outcome. This section will talk about why it's important to balance and track your portfolio's performance over time. First things first, let's talk about balancing the portfolio. The goal here is to allocate your investments in a way that maximizes growth while minimizing risk. For our 3 ETF strategy, you might consider something like 40% in SCHX, 30% in SCHD, and 30% in SCHG. This allocation gives you a solid foundation in large cap stocks, provides income through dividends, and allows for growth potential with high-performing sectors. But why is balancing so important? Well, it helps you stay diversified and ensures that no single investment dominates your portfolio. Over time, as certain ETFs outperform others, you'll want to rebalance to maintain your desired allocation. This might mean selling a bit of the ETF that's grown the most and buying more of the ones that haven't caught up. Regularly checking in and rebalancing can help your portfolio stay aligned with your goals. Next, we have dollar cost averaging. This is a tried and true method for building wealth steadily over time. The idea is simple. Instead of trying to time the market, you invest a fixed amount of money at regular intervals, let's say every month, for example. The goal here is to buy more shares when prices are low and fewer when prices are high, which averages out your cost over time. For instance, let's say you invest $500 every month into your 3 ETF portfolio. This means that regardless of market conditions, you take advantage of market dips and reduce the impact of volatility. Over the long term, this approach can lead to impressive growth as you benefit from compound returns. But here's what's truly interesting. Just to ensure your investments are on the right path, performance tracking is crucial. You can use various tools to monitor how your portfolio is doing. Online platforms like Charles Schwab offer dashboards to track your portfolio's performance, providing insights into returns, allocation, and historical performance. There are also mobile apps like Personal Capital or Mint that can help you keep your eye on your investments, ensuring that you're meeting your financial goals. That's why I highly recommend regularly reviewing your portfolio, because it allows you to adjust your strategy as needed. Now that you have your portfolio in place, let's dive into some financial projections to see how this strategy can play out over the long term. We're going to start by doing a comparative analysis. How does the 3 ETF portfolio stack up against other strategies? Historically, this approach has shown strong performance due to its balance of stability, income, and growth. Compared to a portfolio focusing solely on large cap stocks or bonds, the 3 ETF strategy often delivers higher returns with lower risk, thanks to its diversification across different asset classes. For example, over the past 10 years, a portfolio consisting of SCHX, SCHD, and SCHG has outperformed traditional balanced portfolios, providing an average annual return of around 12%. This demonstrates the potential of this strategy to deliver superior results. So let's say you start investing $500 per month into this portfolio for 25 years. Assuming an average annual return of 10%, your investment could grow to over $530,000. This just shows how the power of compounding and the potential of the 3 ETF strategy can help you build true wealth over time. But it's not just a theoretical setup, it's a realistic outcome for you only if you're willing to commit to regular investing and letting your money grow over the long haul. But as you might already know, risk management is super important, and diversification plays a key role here. The truth is that you reduce the impact of market volatility by spreading your investments across different sectors and asset types with the 3 ETF strategy. Remember that if one ETF underperforms, others in your portfolio can help balance it out, minimizing potential losses. To wrap things up, the 3 ETF strategy offers simplicity, diversification, and the potential for long-term growth. Start building a portfolio that balances risk and return by choosing the 3 Charles Schwab ETFs that we've just talked about. And if you're looking to grow your savings, consider putting some of it into dividend stocks that can really boost your initial investment over time. We've got some great videos on dividend investing that can help you get started. I highly recommend checking out our channel and watching them as well. Thank you for watching.